Alright, so let's talk about accounting transaction analysis. In my previous videos, I went over the accounting equation, and so now what I'm going to do is try to use some real-life examples in order to get you to feel more comfortable understanding this accounting equation, which is that assets equals liabilities plus equity. Equity sometimes is also called owner's equity, or they also call it shareholders' equity. I just usually call it equity, but just keep in mind that they're all interchangeable. Equity, owner's equity, and shareholders' equity. In addition, what I've done is I've included a few asset accounts under assets, such as cash, accounts receivable, supplies, and equipment. I've included accounts payable under liabilities, and an accounts payable is just money that you owe in the future. And then we have the four equity accounts, such as investment, withdrawals, revenue, and expenses. So let's start with, again, like with a real life example. Oh, and before I forget, our goal here with the accounting equation is to always make sure that assets always equal liabilities plus equity. If they don't for any reason, then we got a problem. And I'll go over that in a much later video, in case that happens, what to do. But for now, let's just try to make sure that assets always equal liabilities plus equity, or else you violated the accounting equation. So let's begin with a real life scenario. Let's say that Mark wants to invest in a business, and he starts off by investing $10,000 worth of cash into the business. So now, because we know we're investing $10,000 worth of cash, our cash is going to increase by the $10,000. And because this is an investment into the business, we know that our equity section with this investment subsection right here is also going to increase by the $10,000. And I'll try to keep a running total down here just so that we can ensure that our assets always equal our liabilities plus our equity. So we have $10,000 of assets, and we have $10,000 of liabilities plus equity. And what I'll also do is I'll write a 0 here to show you that there was no effect on liabilities during this transaction. For number 2, let's say that Mark purchased equipment for cash of $200. So now we purchase $200 worth of equipment, so we know that equipment goes up by positive 200. And because it was for cash, we know that cash is going to go down by 200. And for this transaction, there was no effect on account payable, nor was there an effect on equity. Number 3, let's say that we purchase supplies for cash of $100. So when we purchase supplies for $100, we know that we're getting $100 worth of supplies, so supplies goes up by $100, and we paid cash for them. So our cash goes down by $100. So here's the thing. Again, we have no effect on liabilities or equity. So in these previous two examples now, all we've done is switched one asset for another. So when you switch one asset for another, the net effect is actually 0. So there's actually no change on this $10,000 right here. Because if you'll see that we started off with 10, and then we switched cash for $200 worth of cash for $200 worth of equipment, and $100 worth of cash for $100 worth of supplies. So there was no effect, the net effect of those was 0. So for number 4, let's say we purchase equipment on credit for $300. Now when we purchase $300 worth of equipment, we know that equipment is going to go up by the $300 because we bought $300 worth of equipment. But now we purchased it on credit, so that means we're going to pay them in the future. And that's an account payable. So our account payable goes up by 300. And so now let's factor that in over here. So now we have 10,300. I'll cross this out. And also over here, because of that account payable, we increase the 10,000 by the 300. For number 5, let's say that we sell a product for $50. So we receive $50, and because we're receiving $50, we know that $50 is going to go into cash. And this product, the sale of the product is in the normal course of the business. So that is going to go in under revenue, because when you sell a product under the normal course of business, that goes under revenue. So our revenue increases by the $50. So now we have $10,350. And the same goes for this section over here. Now for number 6, let's say we made a payment of accounts payable for $300, which is for this piece of equipment that we bought over here in number 4. So now we're going to pay for it. So when we eventually pay for it, our cash goes down by 300, and our account payable, since we no longer owe it, excuse me, and that also goes down by 300. And so our effect is going to be that we subtract 300 from 10,350, which gives us 10,050. And over here we had 10,350, and we're subtracting $300 from there, and so we're left with 10,050. I apologize, my handwriting's a little bit bad, but again, this is 10,050. You can check the math yourself. Let's go to number 7 now. So for number 7, let's say we sell a product on credit. So we sell the product, and the thing is that we're not going to receive the money yet. So because we sold the product for $10, our revenue is going to go up by $10. And so let's see what is going to happen on the asset side. It's actually going to be an accounts receivable, because an account receivable is money that we're going to receive in the future. So we sold the product on credit, and we're going to receive the money sometime in the future, so that account receivable also goes up by the $10. So now our running total is $10,060, because we added $10 to it. So I'll just write that over here, cross that out. Now let's see, for number 8, let's say that we purchased supplies for $30 worth of cash and $20 worth of credit. So that's a total of $50 worth of supplies, out of which $30 was paid in cash, and there's $20 that we're going to pay later. It's a credit. So the first thing we know is that supplies went up by $50. And since we paid cash of $30, we know that our cash went down by $30, and the remainder we're going to pay later. And because we're going to pay that later, it's an accounts payable, and that is $20 increase in an account payable. Now we know that the net effect between a positive 50 and a minus 30 is positive 20. So over here we actually increase by 20. So this is 10,080 now. And we also have a positive 20 here. So we're going to increase this by 20 and get 10,080. So again, we balance. For number 9, let's say that we paid rent for $500. So $500 worth of rent means that we just lost $500 worth of cash. So that cash is going to go down by 500. And now, because this is something we're paying immediately, not sometime in the future, so it's not an account payable. So I'll just write 0 over there, because it's not an account payable. And because we're paying it immediately, it's going to go under an expense, because rent is an expense, and it's a payment that we're making immediately. Now, expense, actually, technically, we're increasing the expense, but because the effect that expense has on equity is that it decreases or takes away from equity, I'm going to write that down as a negative 500. But just keep in mind that whenever an expense increases, it takes away from equity. So the effect that it's going to have is that it's going to have a minus or a negative effect on equity. That's why I wrote this minus sign over here. And as far as the calculation, let me just do that on my calculator real quick just so that I don't mess it up. So 1080 minus 500 will give us 9,580. Okay. So if we subtract 500 from the 1080, we get 9,580. Normally I can usually do this, simple math, but I just don't want to mess up for you guys. So we're also subtracting over here, so we get 9,580. So our balance right now is 9,580, and both sides balance. Number 10. So let's make a payment on accounts payable for $20, which is this $20 that we had from the purchase of supplies that we still owed. So our cash goes down by 20 because we're paying it now, and our account payable also goes down because we no longer owe it. And the net effect is subtracting 20 from this 9,580, so that's 9,560 here and 9,560 over here. So we'll cross that out. Alright, number 11. We receive cash from account payable of $10, which is this $10 right here. We're going to receive it now. So that means our cash goes up by $10 because now we have $10 that we received, and our account payable goes down by the $10. And again, there's no effect on either liability or equity in this one. Again, it's just switching an asset for an asset. Before we had an asset of account receivable, and now we receive the cash and we no longer have the account receivable. Alright, let's do one final one. Let's say that we withdraw cash from the business, and we withdraw $250. So when we withdraw $250, our cash is going to go down by 250, and our withdrawal is also going to go down by 250. Again, technically, we would say that our withdrawal increases, but because the effect that withdrawal has on equity is a negative or a minus effect, I'm writing this down as a negative 250. And the math is that we have a net result of 9,310, which is the 9,560 minus the 250 withdrawal that we just made, and the same goes for the asset side. So we had a whole bunch of transactions, and we came out good because assets do equal liabilities plus equity. So that's just a basic idea of how the accounting equation works, and those are just a few transactions that we went through.